Good morning and welcome to the monthly market update with Nikko Asset Management. I'm Katie Buchanan. I'm on the distribution team here at Nikko. Before I delve into the topics of the day, just a quick reminder that we'll be hosting a series of investment lunches across New Zealand in a couple weeks' time. We're lucky to have some world-class speakers joining us at this pivotal time in markets. Gurpreet Ghaliwal from Macro Strategist within the fixed income team at Goldman Sachs Asset Management will give insights on economic trends and macro themes that are influencing fixed income portfolios. And then Ian Fulton, the portfolio manager for the Nikko Asset Management Global Shares Fund, will be joining us from Edinburgh, where he'll break down all the themes and cyclical factors affecting their stock picking in the global space. And finally, two familiar faces from Nikko AM New Zealand, whom you'll also see today, Alan Clarke and Michael Sherrock will discuss how all of this is affecting markets and portfolios closer to home. So if you haven't already signed up and you would like to join the lunch in Wellington on Thursday, September 5th, Auckland on Friday, September 6th, or on Christchurch on Monday, September 9th, please just reach out. So needless to say, a lot has happened since our last update at the end of July. New Zealand has had stellar performance in the Paris Olympics and has taken home more medals than ever before in the Olympic Games. Politics and the election in the US has changed course with a new Democratic ticket of Kamala Harris and Tim Walz shaking up the polls, and the RBNZ decided it was time to kick off the pivot party. So joining us today is a lineup of three qualified speakers to break this all down. First up, we have the portfolio manager of our diversified and external managers, Alan Clarke, who will highlight some of the recent SAA changes we've made to our diversified funds, along with a recap of what's been happening in international markets. So Alan, over to you.
Thank you, Katie, and good morning, everyone. My name's Alan Clarke, and I'm the portfolio manager for diversified funds here. And I'd like to take you through the changes that we're going to roll out just shortly on our diversified funds after the recent review. And I'll also spend a little bit of time on the outlook for global equity specifically, and I've sort of got some observations there of where we think the direction of travel is. With the diversified fund review this year, as you'll see here, I do love a good pithy quote, and I thought this one sort of captured what we've done here, which is there are elements of a return to a slightly more orthodox approach for our diversified funds. And I'm going to go through that in a minute. But what you'll see is what we're doing is we're sort of moving our active risk for our diversified funds into the strategies where we believe we've got really strong capabilities of orthodox fundamental active management within each asset class. So these asset class funds are the building blocks for our diversifieds. And our aim is to generate top quartile performance over the medium and long term, using these strategies as the building blocks for our diversified funds. And we'll just walk you through the main changes now. The first one, hopefully coming up just shortly, there it is. So the first one is we're going to change the underlying strategies within the diversifieds for the global equity allocation. As many of you know, previously this has been managed by a combination of the Nikko Edinburgh Future Quality team and an allocation to the ARC Disruptive Innovation Fund. And we're going to change that to allocation to the Nikko Multi-Manager Global Equity Fund, which is a four-manager combination that's been managed here for many years, since about 2008. And we believe that purpose-built combination of four managers, all fundamental active managers with slightly different styles. So we've put them together to complement each other. And what we're doing there is effectively spreading that active risk across more strategies. So we've been more diversified in terms of sources of active return than previously. Still have a lot of confidence in the Nikko Edinburgh team, of course, and the ARC Innovation Strategy is a great investment for those looking for that long-term growth in some of those new and innovative sectors. But within a diversified fund context, the overall sort of volatility, the expected volatility from that strategy is very high. And we think this, in terms of giving our clients a slightly smoother journey, we think the multi-manager combinations are a much better approach here. The second change is to take out the JP Morgan Multi-Manager Alternatives Fund. That's been an allocation within the Balanced and the Growth Fund in recent years. And the main reason for that, this was a very sort of well put together fund of hedge funds approach by the JP Morgan alternative asset management team, but it was built specifically in the post GFC period. It was built for that era of effectively ZIRP, zero interest rate policies that were prevalent around the world, most of the developed markets and a lot of the emerging markets. A lot of the countries had brought interest rates down to rock bottom, and as we know, the future outlook for bond returns for a lot of that decade of the 2010s was much lower than previously, and so this fund was a very sensible approach in that world of very low interest rates. Now, I guess thankfully, we have now a world where interest rates are much more normal. It did take the incredible COVID pandemic and the last 4 years of that sort of amazingly volatile journey that the world's been on to get us there. But we have got interest rates, short term and long term, back to what we would consider much more normal. And that means we're getting a much higher return. We have expectations for a much higher return from those traditional asset classes of good old cash and bonds. And this strategy is sort of, it's again, if we have a return to zero interest rate policies, it's something we'd look at, but we're not going to allocate to it just in the current environment. We've left room within the diversifieds for an allocation to alternatives, so we still are always on the lookout for the alternative strategies that could complement the diversifieds, lift the expected return and or lower the volatility. So we've left room for an allocation, but for the next period, that neutral setting will be zero. The third change is, I'd suggest this is a reasonably minor one compared to the first two, but the growth funds previously have not had an allocation to listed properties. So again, the growth fund, it goes without saying, has the most the highest allocation to sort of risk assets, if you like, or growth assets, so the equities, New Zealand and globally. So it actually does benefits the most from an allocation to property. So yes, property is a listed asset. Yes, it will follow the sort of slings and arrows of the broader equity market, but we think it does deserve a separate sort of asset class because of its slightly unique characteristics, and we think the diversification from that asset class it's needed in the conservative funds, it's needed in the balanced funds, but it's almost needed most of all in the growth fund with around 80% allocated to the riskier assets. The fourth change is to allow for some tilting of the diversified funds. Again, just to go back, previously the diversified funds here at Nico followed what I'd describe as a sort of traditional SAA process where, once a year or on an ad hoc basis if required, the asset allocations were sort of thoroughly and diligently assessed and tweaked and changed, and that's a solid and robust process. But we think that having an allowable range and allowing for a bit more of a tactical asset allocation or a dynamic asset allocation process, what we think there is that if and when, and we do expect it to be a sort of, it'll come again, when we get these dislocations in markets, it helps to have the process in place. It helps to have the ranges in place to allow for us to either move the diversifieds away from risk if we're getting concerned about the outlook, or after a decent sell-off, a decent correction, after a bear market perhaps is the time to be buying equities. So we want to have the range in place, the process in place before that dislocation or event or period of the market cycle comes along. And the problem with the traditional SAA approach is that to benefit from those dislocations, to be able to adjust the mix of assets within the diversified funds, it sort of requires the dislocations to come along around the time you're doing your review. And of course, the markets are never that kind to us. So we think this is going to be a bit more built to manage these funds through a full market cycle. The fifth change we're noting here is, I describe this as a bit more of a technical one and doesn't actually change the way the funds are managed. But previously there were two or three effectively absolute return or cash plus or OCR plus benchmarks. And again, that's sort of fine on the one hand, but what it means for the diversifieds is it does make the the ability for clients to sort of assess our performance, it makes it a bit more complicated, because if a fund is a reasonably volatile fund, or is indeed sort of invested in equities, it's very rarely going to follow the pattern of a cash plus benchmark. And so we're going to move every asset class has got an appropriate market index, and effectively our benchmarks for the diversified funds are going to be made simpler. And the actual official benchmark will be the same as the appropriate market index. And we think that'll make it easier for our clients. We want our clients to be able to see how we are doing in terms of how has our active return been progressing over time. Of course, we believe, we want to be a top quartile manager versus our peers. And we believe if we can, through a combination of these orthodox active management approaches, if we're successful with each one over time, the diversifieds will also generate a healthy return above that composite benchmark. So on the next slide, we've got a nice, pretty summary of all this, and hopefully a lot of you have already seen this through recent communications. But here's the changes. And as you can see, there are some, what you might describe as tweaks, but I guess the major ones are what we just talked about, changing the allocation for shares to the multi-manager. And what we'll be doing with this is to do this gradually. We're hoping to get this done within the next, say, 3-4 weeks, but we will never lock down a specific date or a number of dates. We're sort of always reserve the right to put a sort of transition process like this on hold if markets do start to sort of behave, or if we get a spike in volatility. That's never a good time to move these. So we do look to do this gradually with 2 or 3 tranches in some cases, and we will always sort of hit pause if the markets, if we get a kickoff in volatility. And that's probably a good segue to the next slide, because I do want to spend a bit of time on that. Of course, as you all know, we've had yet another pretty remarkable period of volatility in the last month, particularly around that middle of August, where this is the global equity index, the ACWI. So this, at the time, this was a decent sell-off. We're talking nearly sort of 10%. Now, of course, it has recovered a bit of that, but as you'll all know, that a lot of that sell-off was sort of driven. It's not always the case, but it was actually Japanese equities that were the most volatile. I believe Japanese equities had their worst 3-day drawdown in about 50 years. So there was a sort of, as always with these events, particularly such large spikes in volatility, there were a number of factors at play. But the sort of main culprits were, yes, there was some slightly weaker economic data of the US, but the Bank of Japan finally hiking interest rates, finally trying to move their country out of that zero interest rate policy regime that they've been stuck in for sort of more like decades rather than a decade. That sort of course led to some of this unwind of the infamous yen carry trade. And as we've always seen in past market history, typically volatility can get extremely high if leverage is involved, and the yen carry trade, investors being able to borrow in a very cheap currency like the yen and invest in other currencies, or invest in equities, or invest in bonds, that is a form of leverage. And whenever there is leverage involved, selling begets more selling, and that sort of did explain a lot of that massive unwind in Japanese equities, which after about 3 days, rapidly unwound. And as always on the next slide, what we do try and do is take a step back, and of course, I've just talked about the sort of sharpness of that correction, if you like. And again, most of that would have been because of that leverage. But just to put this in context of the last 2 years, this correction was, depending on how pedantic you get on what's a correction, what's a pullback, but roughly the 5th or 6th decent pullback we've had. Some of them middle of or third quarter of 2023 were a bit more gradual. April this year, August this year, they're all slightly different patterns, but we're always asking ourselves, do we think we're at the start of a new bear market, or is the current sort of market, the current bull market, if you like, intact? And so far, our assessment would be that this is just yet another sort of correction. And yes, in each of these cases is a slightly different theme. The main one running through, as I mentioned with the US, it is still the most important economy for the world, partly because of its size, but partly in the last few years because it's been the one that's held up the best. A lot of countries have had to put up with higher interest rates. A lot of countries have struggled with that or are starting to struggle with that. But the US, for all the tighter monetary policy there, has been the one that's sort of surprised on the positive side. So when we look at, August 2023, April this year, there was sort of the fear was that there were cracks appearing in the US economy, that the Fed would have to keep tightening to get inflation under control. But as is often the case, and I'm going to touch on some of this in a minute, as is often the case, if there's that wall of worry in place and there's a lot of investor fear or a lot of concerns, if those fears aren't realised, that does have the makings of a decent long bull market. So the next slide, I just thought I'd sort of share our a couple of things. When we think about the global outlook for something like global equities, we're thinking, I always think of sort of three main bubbles, if you like. We've got the valuations are very important, fundamentals are very important, but also sentiment and behavioural factors are very important. And it's the latter that I wanted to spend a bit of time on, that sort of investor sentiment. I won't spend too long on valuations. That just to sort of suffice to say that global equities, for example, I'd characterise them as not, certainly not cheap, but I wouldn't say they're over outrageously expensive either. Yes, the Magnificent Seven are richly valued, and then you've got to caveat that with the fact that their earnings power has been remarkable, and the outlook for that earnings power and the return on invested capital and the margins they've been able to maintain are remarkable. And when you adjust it for that, or if you take those out of the broader global equity market, you do get valuations that are okay, so not rich, not cheap, and as valuations are reasonably easy to measure. They're just not a great sort of timing tool in the short term. So we do keep an eye on them, but they'd be put into the sort of so camp. And I just thought, for fundamentals, it's another one where I thought this, US-ism reading on the right here sort of captured it quite well. It's, this is a diffusion index. So basically a high level above 50, you're sort of in expansion, things are good. Below 50, you're in contraction. And what's unusual about the recent period in the US, this is services. So for the US, a very important part of their economy. But what's sort of interesting is that usually these things are either sort of healthy, above 55, up towards 60, or they're in a bit of a hole. And this one has bubbled along in that weird, not bad, not great, so, and again, that there's been that fear that it's going to collapse as it would during a recession. So we've had this, the fundamentals I'd describe are still a touch below par, but also a touch ahead of expectations, ahead of those fears. And we see that on the left there with, bless the economists, they try and predict recessions. And what we've seen over the last sort of 18 months is that fear of recessions. It's still there. It still might happen. Recessions in the US are sort of supposed to happen once every, 6 or 7 years. So you could argue the probability is always about 15%. But yes, certainly when the Fed was hiking rates like it's never done before, that the fear of a recession was very high, and that has eased lately. The next slide is sort of another recent one to capture the headlines, and this is in terms of these recession indicators. This is the SAM rule. So again, it is just a measure of the change in US unemployment. So if unemployment in the US for a 3-month period is above the lowest 3-month average for the last year, this rule has sort of worked so well that it's got a name after the lady who created it. And it's, as you can see here, it's had a pretty good track record of predicting recessions, or at least occurring at the same time as a recession was taking place. And guess what? It's just been triggered again. And again, this is so the question is always are we worried about this? So the next slide, I think the way to look at this would be, this is the SAM rule is sort of the last or the third or third or fourth of sort of other famous or infamous prediction tools. And we've got the New York Fed there. Their prediction tool for recessions is heavily dependent on the slope of the yield curve. So as you can see, pretty good track record. Whenever that yield curve goes inverts and goes negative, that's often a sort of harbinger of some doom. And yet here we've had it go negative, quite a long time ago, and it still hasn't, this time, it hasn't worked. Same as the US Conference Board Leading Economic Indicator. That has fallen quite sharply from the sort of heights of late 2021. And usually that would be a sort of really concerning indicator for us. So we've got a couple more quotes in there. So yes, we do want to learn from the history. Yes, history doesn't repeat, it rhymes. So yes, we want to always learn from previous market cycles. But down the bottom left, we're always asking ourselves, is it different this time? And I think for a lot of this COVID period, the last 4 years, I think we are still in this environment where for a lot of this, we do have to say, yes, it actually is different. There was, we used the word unprecedented so many times to do with, firstly, the monetary and fiscal kitchen sinks that got thrown at the COVID pandemic, and then, of course, the monetary policy restraint following it. So we're not sort of shutting our minds to previous cycles, to previous trends, but we do always ask the sort of questions at the bookends there. Is it different this time, or should we just have treat it a little bit differently? And I think this does explain this continual fear of a US recession, these models predicting it. They sort of inform investor sentiment, and that has helped that's kept that fear gauge quite high, and that's actually healthy for an equity market, bull market. And then the last slide, I think, that's it, I think. Happy to take questions on any of that, and otherwise I'll pass to my esteemed colleagues.
If anybody does have any questions, please just put them in the Q&A chat and I can read them out. Alan, I just had a quick question going back to the SAA changes and just touching a little bit more on our new allocation to global equities. As you mentioned, we've taken it from, one manager, I guess two, Global Shares and ARC, to our global equity multi-manager, which has 4 managers in it. Would you mind just touching on those 4 managers and sort of talking about how their styles differ and why you like the complements of those 4?
Yes, good question. And again, I'll sort of talk in terms of styles. What we've got with the multi-manager at a high level, we can think about sort of 60-40. So 60% are with a couple of managers that would describe as core or style neutral, investing a bit more across the universe. Yes, there'll be some undervalued companies, some cheap companies, some in some industries with troubles, or difficulties and that deep value space, but also some growthier names and sort of everything in between. So the 2 core managers is the JP Morgan Global Select Fund, 60-70 stocks managed by the JP Morgan Asset Management Global Equity Team. The PMs are based in London, a sort of global research platform with sort of getting up on 100 investment professionals around the world, analysts and PMs. And then Roll London, the other sort of 30%. Roll London is also, funnily enough, called Global Select, but a concentrated portfolio of about 40 stocks. And again, that combination of a good all-weather portfolio without a particular style bias at the portfolio level. And that sort of core or ballast for the fund is what we think complemented well by sort of roughly 20% allocation to the Nikko Future Quality strategy. And investing a little bit more in that future, as the name would suggest, so slightly growthier portfolio. So typically always going to have a higher PE, for example, by 3, 4, 5 turns of multiples than, say, the broader universe, but paying up for names because of that their potential growth in terms of whatever industry or technology or product they're invested in, and sort of even, if you like, even further to the right of that growth spectrum, or even growthier, if you like, just by a little bit, would be as WCM, a manager out of the Laguna Beach, California. So they're also in that growth bucket, and again, we think that balance of different styles gives it a really good overall portfolio that's effectively greater than the sum of the parts there, with 4 good managers in combination equaling a really good sensible solution. It's about 160 stocks. Sort of tracking error is going to be sort of 3.5. So and looking to add 2.5-3% per annum over a full market cycle.
Great, thanks. I have one question here. Alan, what effect do you expect the move away from ARC will have on its unit price?
0, because we're very small, and we'll be doing, as I said, we'll be doing it in LICs anyway. But no, the answer would be 0 effect on the unit price. Yeah, that particular fund invests in a very large UCITS vehicle. believe, yeah, our Nico New Zealand Arc Disruptive Fund, I believe, is about $70 million. But that UCITS fund that we're invested in is many multiples of that, with investors from all over the world.
Okay, great. And just one final question. There's been quite a bit of allocation into the global bond fund in these changes. Conservative fund a plus 9%, balance plus 5.5%, and in the growth fund plus 3%. Can you just discuss decision of allocating to the global bond fund?
Yep, good question. That sort of, that does address a bit where every most diversified fund managers around the world have a home country bias, and that's often for tax reasons or familiarity reasons, and in this case the diversifieds had sort of effectively had more in New Zealand than globally. We've just addressed that roughly 50-50 now, local versus global, and that is a pure diversification call. We're strong supporters of New Zealand Inc., but as for our investors, if New Zealand was to have a problem, either a foot and mouth or a monetary policy problem or a fiscal problem, having too much invested in New Zealand, as solid as our institutions are, as our banks are, as our government is, it's not prudent to have too much in a lovely little country at the bottom of the world. So that's effectively just increasing that local or balancing the local global split to what we think is a bit more prudent.
Okay, great. That makes sense. And final question I have online is, why is the expected long-term return for the global equities fund free the changes?
What is the expected return?
It says why is, but it might be what is the expected long-term return for the global equities fund?
So that's in terms of added value, it's easier. We're talking 2.5-3% over. So the expectations for equities, and I don't actually have this figure at the top of my head, but I believe, it's around 10%. In terms so think about that as 7.5 from the asset class. So like I said, valuation's not particularly, slightly rich would have gone into that calculation of 7.5 from the asset class, and then 2.5-3% from active management gets you around 10% per annum for global equities for the next that's for the next full market cycle.
Okay, great. I think that's all for questions. Alan, thank you so much. Appreciate your time.
Pleasure. Thanks, Katie. Thanks all.
Okay. Next up, we have Michael Sherrock, the head of New Zealand Equities. His team have been pretty busy. The NZX saw very strong performance in July, and now they've gone right into reporting season. So I'll hand it over to Michael to give us a recap of what they're seeing out there. Thanks.
Great. Thanks, Katie. Good morning, everyone, and happy Friday. As Katie mentioned, we'll give some observations from reporting season so far, and also just a little market update as well. So it's been a pretty wild ride for markets over the last couple of months, really reacting quite aggressively to words from central banks and economic updates. Economists and forecasters have also been aggressively changing their timing and size of rate cuts as well on economic updates as well. So, that's all interesting. Alan mentioned the Japanese market sort of crash, you could say, and the return post that, and the US market as well has been whipsawed around on contrasting economic data. When will the US Fed cut rates, and how fast will those rate cuts come as well? The Reserve Bank of Australia has been a real outlier. They had their update a couple of weeks ago now, left rates unchanged. In their commentary was really hawkish, saying that there are no rate cuts coming anytime soon, and that they seriously considered raising rates as well. And, we think about that versus the Reserve Bank of New Zealand, where in July they came out quite dovish, unexpectedly dovish versus what they've been saying in May. And on that dovish statement, the New Zealand market, the NZX 50, rose about 6% that month or last month. And the mid caps rose close enough to 10%. So the mid caps being the stocks in the NZX 50 outside the top 10. And then last week, that was all followed up by the Reserve Bank actually cutting rates. But probably the most interesting thing was the track for their OCR going forward from here. It's been moved in quite aggressively, roughly about 1 year ahead of what was previously forecast, albeit still getting to the same position of around 3% by the middle of 2027. So what all this means is good for equity markets. On the day of the rate cut, we saw the New Zealand market up 2%. The following days were up as well. Since then, we've started reporting season, so the returns for the market have been muddied to some degree by what's going on with individual companies reporting and what they're saying to the market. So with all that in mind, and actually I'll point out that the interest rate market is being more aggressive in terms of the timing of rate cuts than what the Reserve Bank is saying. Last time I looked, I think the interest rate market was pricing in an OCR of about 4.5% by the end of the year. The importance of all of this really is that equity markets are really price sensitive to what's going on in the interest rate market, particularly the New Zealand market. I'm just going to share a few slides if you bear with me. So hopefully we've got that on screen there now. No surprises here, the OCR track going back. And then on the right-hand side in the orange dotted line is what the Reserve Bank was forecasting for the OCR going forward back in May. And the quite dramatic move in of that versus what they're saying last week in the green line there. And then just this next slide, talking about the composition of the New Zealand market and how it's relatively defensive and interest rate sensitive. This is a slide that a number of you may have seen in the past, comparing the sector weights of the New Zealand market versus the Australian market, which is somewhat dominated by financials and materials or resources. And then the US market, which is quite heavily weighted towards IT. When we think about the New Zealand market here in real estate, sort of 8 or 9% weight to real estate, very interest rate sensitive sector. Communication services, that's the likes of Spark and Chorus. Utilities in a normal circumstances would be quite rate sensitive. And then in the healthcare bucket, which Fish and Paykel Healthcare sits in there. I'm not really talking about that name, but within there is also the retirement sector, which are rate sensitive in terms of their link to residential, the residential housing market, and so that certainly helps them in the short term with rate cuts. Albeit, the long-term story for the retirement sector is all about the demographics and the aging population. The next slide here, just really showing that relationship in some charts between the interest rate market and the equity market. On the left-hand side, we have the market median price to earnings ratio, and so that's in the black line there. And then in the red line is the 10-year government bond yield, reference to the right axis, but inverted as well. So as you see, as rates have been declining, the market has increased, or what the market has been willing to pay for a given level of earnings has increased. And as rates have come or gone up, the market, that's all reversed, and the market's been willing to pay less for a given level of earnings. On the right-hand side of this slide, in the blue line, we have the total return from the New Zealand market. And then again, the New Zealand 10-year government bond yield inverted on the right axis as well. You can see the close relationship there. Loses somewhat of the sense of that just with the scale I've used, but you can see some dramatic moves over time where bond yields have moved up or down, and the equity market has spiked or dipped on the back of that. But generally, that relationship is strong. We've had the COVID periods where things went a little bit awash, you could say. New Zealand markets has traded sideways as rates have gone up, down to sideways. But the most recent reduction in the 10-year bond yield has seen the New Zealand market increase. So just showing that relationship in those charts there. Just moving on to reporting season. So with this call occurring probably a week earlier than normal, we're smack bang in the middle of reporting season at the moment. So it's been a really busy week for the team. digesting all the results that have been coming out and actually having follow-up meetings with the management teams. Just picking a few of these names out. So we had A2 Milk report a really good result at the start of the week, but where the market was disappointed with that result was the outlook statement. So revenue growth a little bit lighter than expected, as were the margin forecasts as well. And that seems to all be down to supply chain issues. So something that's been a little bit out of their control. So we had a catch up with their management team on Tuesday. Came away from that really comfortable that it is just a short-term issue in the second half of their coming financial year, or the financial year that they're in at the moment. We'll see those revenue growth and margins revert back to what we would have normally expected. So, A2's actually been a pretty good performer despite the pullback earlier in the week. On the back of that update, the stock is still up about 35% year to date, so a strong performance. And then we also had Contact and Mercury report on Monday and Tuesday. The electricity sectors had a lot of attention, given the spike in prices and the low hydrology or hydro generation, given the low lake levels and the gas market as well. That's caught Mercury out a little bit. Their result, again, not an issue. It's their forward-looking guidance, which just given the low hydro lake levels for them just sees them a little bit short, and for their generation, it will just cost more than the market was expecting in the year ahead. A lot of this has been out of their control to some degree. We had the Tiwai Point aluminium smelter negotiations that dragged on. We had the Labour government proposing Lake Onslow, and that just generated a lot of uncertainty and put on hold or pause some of the new developments that would have been occurring. With that all in the past, the certainty is there now. And those developments are starting up again, and we should see good growth in energy generation in the years in the future. In the middle of the week on Wednesday, we had Fletcher Building and Sky TV, I think, which are both quite topical and interest certainly to ourselves. Fletcher Building, look, they pretty much can't catch a break. They've had a tough time. They reported earnings in line with their guidance, albeit that guidance had been dragged down quite materially in recent months. They delivered $509 million, and that compares to about $780 million last year, so a big drop. And a lot of that is on about a 25% fall in volumes in their building materials and distribution businesses. So pretty chunky falls, and that's the economy for us. But earnings are looking pretty challenged again in the year ahead. They're suggesting another 10 to 15% drop in volumes in those divisions for the year ahead. And outside of that, they've got pipe issues in Western Australia that they are potentially going to court to defend, and all of this is pre a number of the write-downs that they've had as well over the year. I guess pleasingly, they have appointed a new chief financial officer and a new chief executive officer who will start in the near future to fill those vacant spots. But yeah, just pretty challenging times. And I saw this morning the Commerce Commission is taking Fletchers to court around some of the rebates that they were providing for their plasterboard to their customers. So again, just a continuation of issues there. Sky TV, and Sky TV I thought produced a pretty credible result given the economic backdrop that we've got. Pleasingly, they delivered a 19-cent dividend in the year just gone, forecasting at least 21 cents for the year ahead. And then in the following year, in line with what they've previously been saying, they expect to be able to provide at least a 30-cent per share dividend, which, looking at where the share price is trading, that is pretty attractive. Near term, the thing for them to sort out really is the rugby rights So they have those rugby rights at the end of 2025. But with all of these big rights, they start negotiating early, and they would expect to be able to update the market by the end of this year as to what that might look like going forward. We had a few results this morning. Haven't had a huge amount of time to digest them, but certainly on the surface of it, Spark, their result and outlook looked pretty soft. And then Channel Infrastructure, which is a name that we've owned for some time. They seem to be trucking along nicely. Volumes for the first half of the year are ahead of what they would have forecast, albeit they've retained their guidance for the full year. Basically just saying that they're being conservative given the economic environment and the government with their fuel price, their fuel security of supply study going on, just being wary of what might come out of that. They did announce the signing of a new storage contract, which is pleasing. So revenue will flow from that in the start of 2027. Next week, we have a few results. Look, in the interest of time, I won't go too much into any of those, but just Meridian will be of interest given what Mercury is saying this week, and then Somerset as well, which has performed well, and one of our larger overweights in our portfolio. They've already produced or supplied their sales numbers. We'll just be looking at what they've got to say in terms of pricing. I'm just going to stop sharing my screen there and just move on to portfolio positioning and performance as well. So our largest overweights continue to be the likes of Infratil, Somerset and Ryman, which both beneficiaries of the interest rate environment and the lowering of interest rates. And then the likes of Contact and Sky TV as well among our larger overweights. In terms of changes over the month, relatively small pluses and minuses. We've added a little bit more real estate into the portfolios, and so that's generally nothing too major in terms of surgery on the portfolios over the month. And then just in terms of performance, so the NZX 50 is up about 0.5% at the moment, month to date. As I say, earlier in the month it was tracking along better, but just with some specific movements on the back of reporting, that has led it to be up about 0.5% month to date, which on the backdrop of last month's close to 6% over the course of 2 months, not a bad return. Our funds, our core and SRO funds, are tracking a touch behind the index month to date, but plenty going on next week with results that can move things around. And our concentrated fund is about 50 basis points ahead of the NZX 50. In the property sector has had a pretty stellar return month to date, up about 7%, and our property fund is tracking pretty much in line to a small amount ahead of that. Look, I'll just hand back to Katie and see if we've got time for any questions.
Thanks, Michael. It's a really good update. I don't see any questions coming in online, but I just had a quick one. So I thought, interestingly, last month with the market up so much, you said around 6%, you really saw some of those maybe lower quality underperformers really sort of catch up and overperform, perform a lot better than some of the stalwarts and defensive names. As a portfolio manager, how do you sort of navigate that when sort of sentiment changes and these names that you might not have focused on before sort of leading the headlines?
Yeah, it's a dynamic industry, new information every day, which we react to and alter the portfolios based on that. But if we think about some of those mid caps that did perform very strongly last month, I think there may well still be a pretty decent reality check on some of them. A number of them were stocks that had downgraded their earnings previously on the back of the weak economy. A number of retailers, as an example. So I think as they start to deliver results over the next few months, some of that reality may come and face investors. Market's always looking forward, buying things for earnings, 12, 18, 24 months ahead. But it is still volatile in the short term, reacting to what's in front of us.
Sorry, I didn't. My mute was on. Thank you so much for coming on, and thank you for your time, and have a great weekend.
No problem. Thank you.
Next up, we have Ian Bellew from our fixed income team. It's no news that it's been quite an interesting few weeks on the fixed income desk. And Ian will just sort of touch on what's happened leading into the cut last week and sort of what he's seen coming out of it in the funds. Ian, over to you.
You, Katie, and good morning, everyone. So I thought I'd start with the best news, and that is that returns from bonds have been very strong over the last couple of months. So in July, we saw long-term bond yields down by around about 40 basis points, and month to date in August, long-term bond rates are down to about 20 basis points. So as you'll know from our commentaries, we've been positioned long duration. So effectively, we've been benefiting in larger capital gains as interest rates have fallen. So the main driver of both absolute and relative returns have really been, the fall in interest rates. And I'll come to it a bit later, but the good news is, look, even though we're seeing large returns out of bonds, I think there still is some more to come over the medium term, but we'll have to be more patient in that regard. So I'll just move on to, what were the main things that happened over the month. So one of the key events was at the start of this week, the NZ Debt Management Office issued $6 billion of a new government 2036 maturity. The demand for that bond was quite overwhelming. They had over 21 billion of interest in people purchasing that bond. Around about 40% of the 6 billion issued went to New Zealand holders. So that's a good sign. Also, to make the issuance a bit more attractive, being that they want to issue larger volume to get ahead of their funding program, they issued at a margin of 6 basis points to their 2035 maturity. Previously, issuance has been around about 4 basis points, so that was issued cheap. So that's basically a record deal size for New Zealand over the last half dozen years plus. And also another big benefit, of course, to the government funding program is that longer maturity New Zealand government bond rates are now about 1.5% from their highs, lower than their highs in yield late last year. So, the problem is that, of course, the funding or borrowing costs of the government, can actually crowd out the ability for the government to spend money on other things. But fortunately, those borrowing costs are coming down. Also, we had a call with the LGFA, the local government funding agency, this week. So it looks like they're going to be the primary funder of the water responsibilities of the local authorities going forward. So the water responsibilities are going to be, established in new CCOs, council-controlled organisations, and they in turn will be responsible for borrowing against, the water capex or maintenance going forward. That does potentially pose some challenges for our GFA, given that they already fund the borrowing program of the local authorities. This will meaningfully increase their borrowing going forward, and the rating agencies had commented just on a couple of points that obviously they're going to have to borrow more, and also the water entities are going to be more highly leveraged eventually in their borrowing requirements. But I guess it's, really two things to take out of this is the LGFA has been very successful in establishing a support base in terms of offshore investors. And, over the last sort of 12, 18 months, they have been funding through Australia. So we think they won't, certainly in the next, 1 or 2 years, they won't have a problem if they need to increase their borrowing requirements. And also it's going to, take quite a long time, at least the next 12 to 18 months to the new water authorities actually start borrowing money, and even longer before their, borrowing programs build up to meaningful levels. So the LGFA is currently rated AAA, and, at least over the next sort of medium term, I don't think that rating will change. Also, another thing that I should point out is in terms of issuance, corporate issuance in New Zealand has been very limited. We haven't really seen anything since really April this year. The benefit for our portfolios is that we got stuck into all the new issues that came out earlier this year. So we participated in around about 12 new issues, generally buying about 2% weighting in the portfolios at a time. And those bonds have performed well. So, the the bond market isn't different from any other market. The largest, I guess, driver is really demand versus supply. Obviously, supply has been very limited or rationed versus demand. So since the first quarter of the year, you've seen, senior credit margins contract by around about 20 to 30 basis points on average, and this has been, supporting the performance of the bond funds. And looking forward, at this stage, it's hard to see a meaningful catalyst that will, bring a large increase of issuance to the market. The supply of, credit is readily available, but just people are reluctant to borrow in this environment. In fact, we've seen, bonds rolling off. So until, corporates and consumers feel more confident about borrowing money, we don't see that story changing in the near term. And also another, I guess, issue exacerbating the problem is that banks have been very challenged in growing their lending books or balance sheets. So in turn, they've been lending to the people that usually issue bonds to the market at more favourable rates, which has also reduced the bond supply. And of course, the biggest or most exciting news of the week was after nearly a year and a half of very restrictive financial conditions, the RBNZ finally pivoted at the August monetary policy statement and cut rates. So they've cut the cash rate from 5.5% down to 5.25%. Their rate track going forward indicates 25 basis point cuts at the next 3 meetings, which is October, November, and February. The market is actually pricing a more aggressive cutting track than what the bank is, and that's primarily because the market is more negative on the outlook for the economy. And the Reserve Bank has indicated that they see the medium-term level of neutral around about 3%. So, here and now, all they've done is really just very slightly taking their foot off the brake. Conditions are still very restrictive. We've gone from 5.5 to 5.25. Of course, the first green shoots, I guess, in terms of recovery will be that we should see some improvement in business and consumer confidence, but actual flow through, in a meaningful way to borrowers is going to take quite some time yet. And it's always, the magnitude and pace of rate cuts and the actual terminal rate will be very much subject to, I guess, the evolution of the data, particularly around inflation in the economy. So, just as a recap of where we're at the moment, New Zealand inflation, the CPI, is currently at 3.3%. We are dropping a high inflation quarterly number later in the year, and the Reserve Bank, expects that by the time we get to September, inflation will have fallen to around about 2.3%. As you know, GDP has been very subdued. So GDP year on year is only 0.3% positive. 3 of the last 5 quarterly outturns have been negative for New Zealand GDP, and the Reserve Bank is forecasting that the next 2 quarterly outturns will also be negative for GDP. Also, inflation, New Zealand inflation got down to a little bit under, around about 3%. So inflation has picked up. We're sitting, unemployment has picked up. So we're currently sitting at 4.6% in unemployment. I guess it hasn't felt like a disaster yet, the increase in the unemployment rate, but the Reserve Bank has that, and most commentators forecast that going over 5.5%. So the next 1% deterioration or increase in the unemployment rate, I think, would feel a lot more substantive than the previous 1% rise. Moving on, the Reserve Bank certainly popped a fair bit of criticism or robust questioning in the MPS meeting as to why or how they dramatically changed their view versus their May policy statement, where they did indicate that there are risks in both directions, but they certainly highlighted that there is more upside risk at that stage. And so, the market has been critical. Why the sudden turnaround in your view? And the Reserve Bank's response to that is that they reserve the right to change their mind. And I guess it's fortunate that they have changed their view, because we certainly see New Zealand economy has been in a deeper hole relative to Australia and the US, where it looks like we're more likely to have a soft landing. But the Reserve Bank said they've been paying a lot more attention to the high frequency data. So, CPI, GDP, a lot of our first tier data only comes out on a quarterly basis. And that's quite historical. But looking at the more frequent data, electronic cards spending, employment data, job ads, truck movements around the country, it enables the bank to have a better gauge of what current activity is and what intentions are going forward. In terms of intentions going forward, two of the key indicators they put more weight on are the manufacturing MPI index and also the services index, the PSI. So they're a good indication of future activity or intentions from the manufacturing sector and the services sector in the economy about how they're seeing the world and what their intentions are going forward. And both of those indicators have been very dire or negative. They've been stuck basically at GFC levels for many, many months now. So that it does not look very promising. And overall, the Reserve Bank have highlighted that they see, the forecast output gap as being more negative. So basically what they're saying is there's a lot more spare capacity growing in the economy than what they previously expected. And what that means is if you've got more spare capacity, then the pressure on input costs, labour, etc., should reduce, and that'll flow through, I guess, to lower inflation outcomes. Also, the bank has commented that they see, the government has been fairly neutral in terms of their impact on the economy. Obviously, the government has a fair bit of money to borrow over the next 2 or 3 years, and so the fiscal spend, their ability to stimulate the economy through spending has been quite severely contained, certainly to what it was, during the COVID boost, and that's probably in contrast, to the US, where the fiscal spend has remained fairly robust. So we are going to have tax cuts, but net on net, the Reserve Bank sort of sees, the fiscal spend versus the tax cuts as, fairly much sort of a +1, -1 relationship, one sort of washing out the other. And also looking at, I guess, government activities, obviously, Wellington, you talk to people, they say that situation's been a lot more dire there in terms of, I guess, unemployment. So, they've been shedding public sector jobs, and in turn that, flows through, I guess, to, wage inflation. We're largely through, I guess, the process of increasing wage awards for the public sector, and quite the opposite, really. I guess people are probably more concerned about their jobs now. Another major concern, of course, unsurprisingly, is China. China, I guess, has struggled with a deteriorating property market, and that flowing through to a much more negative consumer. Not wanting to be totally negative, of course, a bright spot has been that the auctions for New Zealand dairy prices have recovered quite substantively in the last few auctions. So dairy prices at auction are up a little bit over 35% from their 12-month lows, and we're looking at dairy payout maybe north of $8.50 per kg. So that's quite positive. Dairy is one of our major exports as well. Obviously, immigration has been declining. So previously, that's been quite a substantive supporter crutch for the New Zealand economy. Largely the New Zealand economy has grown just through having more people here rather than necessarily productivity. And the Reserve Bank certainly highlighted that productivity growth is really what we need to see in New Zealand. But two of the major hurdles for New Zealand in terms of productivity growth are, first, people need to be confident to spend money, and secondly, because we're a small nation and we're quite a long way away from the big marketplaces, that's also difficult. And I guess the third point is that a lot of our income comes from commodity exports, which is it's quite hard to move up the value add or value chain, and also tourism, and again also it's a lot difficult to achieve a lot of productivity gains in tourism as well. Also housing, I don't think we have immediate threat in terms of house prices accelerating. Obviously there's quite a backlog to clear there, although the Reserve Bank has cut interest rates, monetary policy lags do take quite some time. So, I don't think we're in danger of seeing a rapid acceleration that would slow the Reserve Bank rate cutting cycle, certainly in the next 12 months. And also mindful that I'm getting through in terms of time. So, look, just summarising, where to from here? Look, I think there are, more gains to come from bonds. If you look at the long end of the government curve or LGFA, long government's around about 4.5%. Government bonds are 5%. Longer maturity government bonds. If we get to cash rate of 3%, then they're going to look like high yielders, and I think those rates will come down. So I'll just pause there.
Thanks, Ian. I just wanted to make sure we had time for any questions that wanted to come in through the Q&A. I mean, you were sort of going there with your last point there. I have just one question. Do you think bonds are going to outperform cash over the next 12 months, given the recent performance?
Yes, so for bonds and cash, look, what we're trying to achieve, I guess, is a balance of, maintaining a higher yield on the portfolios. The yield curve is, cash is 5.25 is your highest yielding point, and then, it falls right down to 5 years, and then the yield curve is positive shaped again. So the balancing act is, locking in a higher yield in those short-term rates versus participating in capital gains through locking in longer maturity yields. At some stage, there will be a crossover if rates fall, but we're positioned long duration in the bonds. We're trying to keep the yield up, so we'll participate in capital gains if rates fall, and the same thing in the cash funds as well. Look, of course, we may, if the economy does deteriorate further and inflation falls or cools more rapidly, we may even get some 50 basis point cuts, which means that you're looking at more capital gains.
Great. All right, I think we're just over time, so I think we'll cut it here. Thank you, Ian, and thanks to everyone for joining us. Have a great weekend.